Miami's skyline stretches out, glittering under the sun, but something's off. The usual buzz of cranes and construction has quieted. Then bold letters flash across the screen. 19,000 homes unsold. It's a number that hits hard. Just 3 years ago, this city was a hotspot, with buyers lining up and prices soaring. But now, the market's in free fall. Back in 2022, there were only 6,376 homes sitting empty. Today, that number has nearly tripled. What happened? Well, it's a mix of rising interest rates, insurance costs through the roof, and a whole lot of uncertainty. Developers who bet big are now scrambling, and families who dreamed of moving here. They're rethinking everything. Miami's real estate boom has turned into a bust, and no one's sure when or if it'll bounce back. The numbers don't lie. Foreclosures in South Florida are climbing fast, and it's not just a blip on the radar. Month after month, the line on the graph keeps shooting up, a steep climb that's got everyone from homeowners to investors on edge. At the same time, something unexpected is happening in downtown Miami. For years, rents have been pushing higher and higher, but now they're finally starting to drop. It's a shift that's turning heads and raising questions about what comes next for this once booming market. You're looking at a map of Miami-Dade County and those red zones? They're not just random markings, they're trouble spots. Home values are taking a nosedive, and in some neighborhoods, the drop is the steepest we've seen in over 10 years. It's not just a blip on the radar, it's a full-blown trend that's got homeowners and investors sweating. If you're thinking about buying or selling, you'd better pay attention because this isn't just a dip, it's a warning sign. The market's shifting and fast. Back in 2022, Miami-Dade was in a real tight spot with just 6,276 homes up for grabs. Buyers were scrambling, bidding wars were heating up, and prices were skyrocketing because there just wasn't enough to go around. Fast forward to 2025, and the picture looks a whole lot different. The number of available homes has shot up to 12,450, more than double what it was just 3 years ago. That kind of growth means buyers finally have options. The pressure's off, and prices are starting to settle into something a little more reasonable. It's a whole new market out there. The median home price in the Tri-County region soared to $540,000 during the market peak. It was a time when buyers were scrambling, bidding wars were common, and prices just kept climbing. For months, it seemed like there was no ceiling, no limit to how high things could go. But as we all know, what goes up must come down. That peak marked the turning point, the moment when the market finally took a breath and started to shift. It was the high water mark, the number everyone would look back on and say, that was when it all changed. Sales volume in July 2025 collapsed to 1,882 closed deals, down 16% from the previous year. That's a sharp drop, and it's not just a blip. It's a trend that's been building for months. The numbers don't lie. Last year we were riding high, but now we're staring at a reality where fewer deals are closing, and the ones that do are harder to come by. It's a wake-up call, plain and simple. The market's shifting, and if we don't adapt, those numbers are only going to get worse. So what's the plan? Because standing still isn't an option. The median condo price in Miami-Dade took a noticeable dip this past year, falling over 4% from where it stood before. That puts the current median right at $460,000, a shift that's got a lot of people talking. Whether you're looking to buy or just keeping an eye on the market, this kind of change doesn't go unnoticed. It's a reminder that even in a hot market like Miami, prices can still adjust, and buyers might just find a little more breathing room than they expected. Living in a condo in Miami-Dade sounds like a dream. Sun, sand, and all that. But lately, it's been more like a financial nightmare for a lot of folks. Condo associations are slapping owners with these massive special assessment bills, and we're not talking pocket change here. We're talking $50,000, $70,000, even $100,000 per unit. That's enough to make anyone's wallet scream. These aren't just little fees for a fresh coat of paint or a new mailbox. These are huge sums meant to cover major repairs or upgrades, and they're hitting owners all at once. Imagine getting a bill like that out of the blue. It's enough to turn your dream home into a financial burden overnight. And the worst part? A lot of these owners didn't see it coming. They thought they were set, paying their regular dues, and then boom! Here comes a bill that could wipe out their savings. It's a tough situation, and it's got a lot of people wondering if they can even afford to stay in their homes. Because when you're hit with a bill that big, it's not just about the money, it's about the stress, the uncertainty, and the tough choices that come with it. So, what can you actually do if you're caught in this mess? Let's break it down. First, if you're an investor, don't panic and sell everything at once. Markets go up and down, and history shows they usually recover. Instead, take a hard look at your portfolio. Are there assets that are still strong long-term bets? Maybe it's time to rebalance, shift some things around, but don't just bail out of fear. Now, if you're a homeowner, this might be a good moment to lock in a fixed-rate mortgage if you haven't already. Rates are all over the place, and if you can secure something stable, it could save you a ton of stress down the road. Also, think about refinancing if it makes sense for your situation. Every little bit helps when things are uncertain. And here's something both investors and homeowners can do. Stay informed. I'm not talking about doom scrolling through financial news all day. Find a few trusted sources, maybe talk to a financial advisor, and make decisions based on facts, not fear. The worst thing you can do is stick your head in the sand and hope it all blows over. This crisis won't last forever, but how you handle it now could make all the difference later. When it comes to investing, it's easy to get caught up in the excitement of high-risk, high-reward opportunities. But let's take a step back and think strategically. First, consider diversifying your portfolio to include more stable markets. Things like bonds or blue-chip stocks that might not make headlines but can steady your returns when the market gets choppy. Next, don't overlook the power of rental income. Whether it's real estate or even leasing out assets you already own, generating passive income can be a game changer. It's not just about waiting for the market to bounce back. It's about creating your own cash flow in the meantime. And finally, stay sharp. Keep an eye on the trends, the news, and the little shifts that signal a recovery. When the moment comes, you want to be ready to act, not scrambling to catch up. Because in investing, timing isn't just about luck, it's about preparation. So here's the thing, staying informed isn't just about knowing what's going on, it's about being ready for what's coming. When you're in the loop, you can spot opportunities before they pass you by and dodge problems before they knock you down. It's like having a map in unfamiliar territory. You wouldn't wander blind, right? Same goes for life, work, or whatever's on your plate. But here's the kicker. Information alone isn't enough. You've got to act on it. Proactive people don't just wait for things to happen. They make things happen. They ask questions, dig deeper, and take steps, even small ones, to stay ahead. Because when you're informed and proactive, you're not just reacting to the world, you're shaping it. And that's how you stay in control, not just along for the ride.